Welcome to this video on down rounds, an important concept in startup finance. A down round occurs when a startup raises capital at a lower valuation than its previous funding round. While this situation can be challenging for founders and early investors, understanding down rounds is essential for anyone involved in the startup ecosystem. Throughout this video, you'll learn what causes down rounds, their impact on stakeholders, and real-world examples of companies that have experienced them. Let's start with a clear definition. A down round is a funding round where a startup raises capital at a lower valuation than its previous round. In simpler terms, the company is now worth less on paper than it was during its last fundraising. This is the opposite of an up round, where valuation increases. Down rounds indicate that investors believe the company is worth less than before, which can happen for various reasons that affect the company's performance or market conditions. Here's a straightforward example to illustrate the concept. Imagine a startup raises its Series A round at a valuation of $50 million. Later, when it's time to raise a Series B round, the company can only secure funding at a valuation of $40 million. This $10 million decrease means the company went through a down round. The new investors are essentially saying the company is worth 20% less than what previous investors believed it was worth. There are four main reasons why down rounds occur. First, missed targets. The company failed to meet its growth projections or key performance indicators. Second, market conditions. Economic downturns or sector-specific declines can reduce valuations across the board. Third, cash runway. Sometimes companies desperately need capital to survive and must accept lower terms. Fourth, over-evaluation. The previous funding round may have priced the company too optimistically, and the market is now correcting that valuation. Down rounds have significant consequences for founders. The most immediate impact is dilution. Because the company is worth less, founders must give up a larger percentage of ownership to raise the same amount of money. This means their stake in the company they built decreases substantially. Additionally, team morale suffers when a down round becomes public knowledge, as it signals trouble to employees and can affect motivation. Finally, reputation takes a hit, as down rounds signal to the market, competitors, and future investors that the company is struggling. Investors often include protection mechanisms in their agreements to guard against down rounds. Anti-dilution rights allow investors to receive additional shares to maintain their ownership percentage when a down round occurs. There are two common types: full ratchet, which converts previous shares at the new lower price regardless of how much money is raised, and weighted average, which adjusts the conversion price based on the amount of new capital raised. These protections benefit investors, but further dilute founders and employees. Several well-known companies have experienced down rounds. Snapchat faced a down round before eventually recovering and going public. Blue Apron went through multiple down rounds amid intense market challenges in the meal kit industry. Groupon struggled post-initial public offering with decreased valuations. Perhaps most notably, WeWork experienced a dramatic valuation collapse from $47 billion to under $10 billion, making it one of the most significant down rounds in recent startup history. These examples show that even high-profile companies can face valuation challenges. Let's recap the essential points about down rounds. First, while down rounds signal company struggles, they aren't always fatal, and some companies successfully recover. Second, founders face significant dilution and reputational impact, making down rounds particularly painful for those who built the company. Third, investors protect themselves using anti-dilution provisions that shift more burden onto founders. Finally, remember that some companies do recover and thrive after down rounds, using the capital to turn their business around. Understanding down rounds helps you navigate the complex world of startup finance more effectively.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.